I'm going to introduce Dr. Moses Asom, who is the general partner in Black Venture Capital Consortium. He's also the co-founder of blackanddeeptech.com, Black and Deep Tech Organization. He has a PhD in electrical engineering from Howard University, as well as an MBA from the Wharton School in UPenn. And Dr. Asom will be introducing the rest of the panel. So please.
Thank you, Nadia. I think this will be one talk where you are not going to see any math or any science per se. You see applications. But thank you so much, and it's a pleasure to be here with everyone. This session is a little bit different from others. The purpose of this session was to introduce you to what it takes to start a company. There's a lot of research, a lot of science, and we want to walk you through what VCs look for in trying to fund companies. In addition to that, we will have an example company or a case study, and they're going to go through their journey and hopefully share that with you. My background is I went to Howard, got a PhD in electrical engineering, and I did my postdoc at Bell Labs, and I spent pretty much most of my life at Bell Labs until I took a couple of years, went to B school. Then I came back to the labs and was part of the team that took tech out of the labs and spun them into companies. Used to call the New Ventures Group. We did about 30-something companies within a 5-year period. I left to co-found with two of my other Bell Labs colleagues to co-found a company called SciChip. Within 6 years, we sold it to Murata Electronics. And since then, been doing lots of very early stage ventures. So that's kind of my background. And today I work with one of my colleagues is here at BVCC. Our goal is to invest in Black and brown founders, especially in deep tech. We've been fortunate enough to partner with DCVC. That's why James is here. And they have a $5 billion fund, and most of their investments are in deep tech. So the way we're structured the talk today is James is going to go through what it takes to fund a venture, a startup in an area like this that is super competitive. Oops, sorry. So he's going to go through the decision-making process, that your technology has to be ready. And obviously you have to, it's not just about the science and the tech, it's also about the team that you put together to go launch your venture. And so there are lots of things that are kind of have to coalesce together to be able to successfully launch a company. The second part of the discussion will be, again, as I said, the case study, where you have Claire and Bharat, a super successful team here in the AI space, and they'll walk through an example of what it takes to start a company, and then we end the rest of the session with just some Q&A. So you guys have been exposed to, oh, nice. Oh, I just moved this. Is it you? Just moved the cable. I did. Clearly, you're familiar with what happens in academia. Most of you are doing research. Lots of activities in the government, including government labs. And of course, you have the big boys and girls. And then the last segment here, which is what we are going to focus on, will be on the startup landscape. Now, lots of activities in quantum tech, as you guys obviously know at this point. In three key areas, which, again, you've been discussing for the past 2-3 days, which is in computing, security and sensing, What is interesting is that tremendous amount of potential investment, especially from countries. They have pledged over $40 billion in quantum. So for the next 5-10 years, it looks like countries are going to put lots and lots of money into different aspects of quantum. So I think this is another potential source for funding, especially for startups as well. You have over 800 groups that are working in quantum technologies globally. Lots of activities at national labs. One thing that is interesting is that if you look at what has happened in terms of investment on the private side, for almost from 2020 to 2002 to 2020, less than $1 billion investment. In the past few years alone, in the private sector, you're seeing over $5 billion of investment in quantum tech. So that shows you that, there's lots of excitement. And you have over 300 companies have been formed in the past few years, right? So again, this is continuing to grow. We talked about, it's obviously not just here. I think China has pledged to put in about $15 billion into quantum tech. So this is distributed almost globally. Again, lots of money is going to come in from the public sector. This just gives you a sense of some of the startups in the space over the past, since 2001. See, for a very long time, you had 1, 2, 3 here, 4 here. And then if you look in the past 5, since 2016, there's tremendous growth in terms of the number of companies that are in this space. One of the challenges here is that now you need a workforce, right? Over the past few days, you realize that it's really, you have different disciplines. You have to have background in almost different areas to be able to participate in this, which is good and bad. If you have skills in this area, of course, you're going to be employed for a very long time. But this is what is driving it. If you look at some of what the analysts are saying, in the next 10, 20 years, you're going to create a $1 trillion industry. That's the excitement in quantum. So the past 3 days have been very educational to most of us. We think tremendous opportunities on the way. What the option that we have and we're going to be talking about is, if you don't want to be in academia, if you don't want to be in the national labs, there is a pathway, another pathway. And this is starting the company, if you have unique technologies. So with that, I'm going to let James step on and tell you, if you have a unique technology and you want to start a company, he's going to tell you what it would take for you to get that venture capital to start your quantum company. James, oh yes.
Sweet. Hey, thanks everybody for coming in. I think you guys have gotten a lot of technical talks today. I am not going to be a technical talk. I'm just going to talk about VC, which stands for venture capital. This is kind of the outline of the talk here. I think at the beginning, I just want to give some people background on what venture capital is, in case there's not a lot of familiarity in the room. I want to spend a little bit of time talking about what do we look for in companies and founding teams. And then I'll talk a little bit specifically about the quantum space. Maybe as some context, DCVC, I think as Moses said, we're relatively large venture firm at this point. We have about $4 billion under management across all the funds that we manage. The focus of the fund is applied AI and deep tech. So all of our companies are building some kind of proprietary data sets or some kind of machine intelligence or otherwise built on science or engineering innovations. And in that group, we have an active quantum practice, I'd say. So we've invested in the seed round of Rigetti Quantum Computing, which is one of the first superconducting qubit companies. I really credit Chad Rigetti with kind of kicking off this current wave of quantum startups. We're investors in a company out of Australia called Q Control. They make control pulses and control technology for actually helping people get better performance out of their quantum computers. And they also make quantum sensors, which I believe you guys have heard a lot about today. And they're also investors in some application layer companies. There's a company called Protein Cure, which was using quantum computers for discovering new therapeutics. And there's a number of others, but those are probably the most notable. And so with that, let's get into it. So what is venture capital? So this is just a definition, right? Venture capital is private equity investing in early stage and emerging companies that have high potential for growth. And so I think the things that I want to call out in this definition are private, right? Private versus public capital. So, a lot of people are familiar with the stock market, companies that go and list on the New York Stock Exchange or the NASDAQ. Those are public companies. They get retail investors like, you and I, or other people who invest in companies that list publicly. They get investment directly, right, from these sources. And the thing about those companies is they usually need to be very mature, right? There's a lot of reporting requirements. There's a whole bunch of things that you need to do in order to be able to go and list on a public exchange like that. All the companies that we invest in are not that mature, right? They're very early. They're high risk, and so public equity markets are just not accessible to them. And so they raise money from private investors. Sometimes that's high net worth individuals. Sometimes that's professional investors like VCs or others. But basically, people who invest directly into a company, and those individuals usually need to hit specific requirements in terms of their sophistication as an investor in order to be able to kind of like take on that risk, right? So there's a whole bunch of regulation, usually to protect retail investors. From being scammed from companies that show up and kind of like promise the moon, right? So that's an important distinction. Venture capital is private versus public, in case people aren't familiar with that. I also want to talk about equity versus debt, right? So the whole idea of equity investing is you're taking on a lot of risk. You might get wiped out if the company fails, but you also participate in all of the upside. Debt investing usually sits on the very top. So if a company goes out of business, the debt people get paid first, right? So it's by definition like lower risk capital, but you also don't participate in the upside. Usually the contract when you make a debt investment is you're going to get 5, 10%, some number per year, regardless of how well the underlying company does. So usually those companies who can raise debt need to be much more mature, have kind of stable financials. They need to be lower cost, or not lower cost, lower risk. And so you've heard me talk about risk a lot, right? And maybe you've heard me talk about growth. And so what does that actually mean in these markets? So for VCs, when we're talking about risk, 67% of startups fail. Like, we're not going to get any of our money back. So you can imagine, like, hey, if 67% of the time, like, we get a zero and we put in millions of dollars, the ones that do work, right, they need to not only pay for themselves, but they have to pay for everything else that failed. And so they need to, we need a really large return on our capital invested there. And so that's why they need to be high growth. And what does high growth mean? We're looking for companies that usually can get to $1 billion or more in valuation in less than 10 years. And the context on that is when we raise money, right? Like, where does our money come from? Well, usually our money comes from, I'd say, even larger managers of capital. They come from university endowments, right, that are managing billions of dollars, like Harvard's endowment. They come from hospital systems. They come from pension funds. Sometimes they come from very high net worth individuals, but the three are kind of the biggest sources of capital for venture investors. And so you can think about, like, if we don't make a return on our investment, hospitals can't keep the lights on, right? Teachers don't get paid their pension. Like, the university, like, can't pay its professors or run its operations. And so, our job we take very seriously, because the people whose money we take, they have very important jobs. So again, I go back to high growth. These companies to become like worth $1 billion or more in less than 10 years. And again, that 10-year point is important because the contract that we make with our investors is they're going to give us money, and then in about 10 years, they're going to expect that money back, right? It's not like a perpetually managed fund. And that puts pressure on startups, right? So that's why that timeline is so short. Like, we can't be investing in companies that are going to take 20, 30 years to reach maturity, right? We just don't have that much time. Just the nature of this market is it needs to happen. And finally, as you guys kind of learn about, like, hey, tactically, like, what does this look like, right? What do we talk about when we're talking about venture funding? Well, usually companies raise rounds in series. So kind of they raise a little bit of money to make some accomplishments, demonstrate that they can execute. Then they'll go out and they'll raise some more money, so forth and so forth. And they're usually called these things. So the first round is typically called a pre-seed round. Then there's a seed round, and there's a Series A, B, C, and so forth. And eventually, you'll get to an IPO or an M&A, and that's when there's actually an exit. So I have two examples of companies in our portfolio, just to give you a flavor of like what these companies raised, right, over time. And so the first one is a company called SentinelOne. They were a cybersecurity company. They had a product that sat on your PC or your laptop and would look for kind of malware or anomalous activity. And they raised about $700 million over the course of about 7 years. And you can see in each round how much money they raised. So their first round was $3 million. It was basically a team, an idea. This was an Israeli team that came out of the military intelligence unit, and they moved to the U.S., raised $3 million, which is this idea, kind of built a product, so then $12 million to kind of start to scale that product and sell it. And then over time, right before the IPO, which happened, I guess I don't have the date on there, but when that company IPO'd, it was worth about $9 billion. As you can see, again, this expectation, right? We're going to go from founding the company in 2013 to an exit, and I believe it was in 2021, for something that's worth more than $9 billion. The second one is a company called Recursion. On the left-hand side, it's a drug discovery company. So they had to raise, also a lot of money because they need to push drugs through clinical development process. They raised about $500 million. And when they IPO'd in 2021, they were worth almost $3 billion. So this is kind of the trajectory of what, a successful company or what a successful investment for us looks like. Again, just to give you guys a sense of what these numbers can actually look like. And so Moses said we weren't going to do any math. We are going to do a little bit of math. So just to bring home, what my job is, right? So let's assume I raised $500 million. So that's the fund, right? And so I need to make a return on that. And typically the return expectation for venture funds is about 3x, right? So 3x in 10 years. And so that means I need to take that $500 million and I need to turn that into $1.5 billion. Typically when I invest in a company, I'm looking to own somewhere in between 20 to 25% with the initial investment. As you guys saw on the previous slide, other investors will come in and buy parts of the company in those subsequent rounds. So my investment will kind of get diluted down to somewhere in the 10 to 20% range, depending on how much subsequent investors have come to buy. And so if I'm only owning 10 to 20% of a company when it goes IPO, that means that in aggregate, all of the companies that I've invested in need to be worth $15 billion, right? In order for me to own $1.5 billion and generate that 3x. And so I'll just go back one slide. So in this case, SentinelOne, they were worth $9 billion. Recursion was worth about $3 billion. So if we added those two together, that portfolio plus maybe some of the other companies in it needed to be worth $15 billion. These two got us to about 12. And so I just want to give you guys a sense of like what these numbers look like. They get big really fast. And so venture investors, we can only really invest in companies that can get really big, really fast. And we're talking about billions and billions of dollars. And I provide that context, and I'll ask a question in just a second, because sometimes people show up and they pitch me a company and they're like, I think this company can be worth $200, $300 million. And that sounds like a big number, right? I mean, any reasonable person think that's a big number, but it's not a big enough number for us in order for the math that we're trying to run to work. There was a question over here. Oh, hey.
Okay. So how does the math look like for the owner? Like suppose one of these grad students or postdocs says, okay, they're starting a company.
Yeah.
And then you have these different rounds. And
Yeah.
You're not the only one who's losing ownership. I assume that they're losing ownership.
Yeah, that's correct. So your question is basically how much does a founder own at exit of a company? Typically. Yeah. And it varies a lot by industry and how much capital gets raised and things like that, and how many founders there are. It wouldn't be uncommon for an owner, for a founder to own usually between 5 and 15% for companies like that. And some of this is public information. You can also go look at like the public filing documents. So I think the Recursion founder owned a little less than 10% upon exit. And the SentinelOne founder, I actually don't know top of mind, but the Recursion founder I think owned about 10%. So if that company went public for around $3 billion, he didn't sell all the stock, but ostensibly he was worth, $300 million. So it's kind of what the numbers can look like. There's a question back here.
So you mentioned that the numbers have to be big enough for you to be worth you guys' time, right?
Yeah.
So what's your typical smallest seed that you'll start with?
Yeah.
Right? Because, then you have this big barrier of entry to say, hey, I have to come to you with an idea worth this amount that will eventually be worth that amount.
Yeah.
So I'm asking on the lower end, right? Because most ideas you come up with aren't going to eventually become $15 billion companies.
Yeah.
What type of your smallest seed investments would you have?
You're looking like the smallest outcome that I would consider, or
My smallest seed investment.
like check size?
One was, I think, $1 million. The other one was 170,000. For the two companies you gave.
Oh, I see. You're looking here. Yeah.
So you 3 million, 170,000.
Yeah. So there's typically different firms will invest at different rounds. So we typically do seed and Series A rounds. In Recursion, we did the Series A, where we put in around $3 million. And then the Series B, we put in around 15. So we didn't invest in the seed round. And then in the Sentinel 1 round, we did a couple $100K in the seed round and then a couple million in the Series A. And that's probably that's the smallest check we would ever write. It's typically like $500K at this point is probably the smallest check we would ever write. But usually at that point, we still kind of need to see, hey, if this company does what it says it's going to do, it can still become a really big company. So I do want to talk about, getting ahead of myself here. Okay, we talked about $15 billion in enterprise value. And so I do want to talk about what do outcomes look like in VC, right? So VC outcomes typically follow what's called a power curve. There's a little bit of math here too. But basically the biggest outcomes dwarf almost the entire remaining set of outcomes. And so this is some actual data that we pulled from CB Insights, which is not really a database, but they track a bunch of startups and startup outcomes. And it's not uncommon to see curves like this when you look across the industry. So the biggest outcomes, the ones over here in this bin all the way to the left, that's going to be like Airbnb. It's going to be like Uber. It's going to be like Snowflake. I don't know if you've heard of Airbnb and Uber, I'm sure. But those companies, when they went public, were worth on the order of $100 billion, right? Each of them. And the next set of outcomes is a lot smaller, right? You're going to have maybe you, every now and then you'll get like a $10 or $20 billion outcome, something that looks like Slack. And then the numbers drop off and most of them aren't worth that much at all. So this, when you look in aggregate across the entire VC industry, this is what outcomes look like. And that's important because, it's not a business where we're concerned with averages, right? Like the average of this is actually pretty bad. We're really concerned only with the outlier companies. And so if you look at a given VC fund, when you're trying to construct it, we might make 20 to 30 investments in a given fund. And that means every investment that we make needs to have the potential to be one of these outlier outcomes because we just don't have that many slots, right? And so we can't waste it on a company that we kind of know a priori wouldn't be able to hit the return threshold. And so here's a kind of a simulated VC fund, right? Where if I'm trying to get to that $15 billion in enterprise value, and I assume I have a distribution that kind of follows this power law curve, right? Where here on the far left, most of the companies are worth zero. And this is a little bit different than the last curve you saw, but same idea. Most of the companies are worth zero, and there's a handful of outlier curves. And then over here on the right, we have just a table that shows what the outcomes were like. Most of my money is going to be driven by 2 or 3 companies that are actually able to achieve, the potential that they had. And so every company that I invest in, I kind of need to see line of sight to, hey, could this be a $2, a $4, $6 billion company? And so again, just trying to drive home, just to make the math work, these are the kind of outcomes that we need. Yeah.
Since you're focused on predominantly minority group of these VC-backed tech companies, how do you gauge the potential? What is the deterministic factors that you look at in a company and you're like, hey, this really does have the potential?
Yeah.
Because I'm sure when the person comes to you for money,
Yeah.
they'll make it seem like it's heaven on earth.
Sure. Yeah.
But you
Yeah.
as an investor, how can you read into the details and say,
Yeah.
this is not really what you think it'll be?
Yeah. So that's the next slide, right? What does it take to make a $1 billion company, right? So these are 2 companies. We're investors in Confluent, Altair. We're not investors in. But these are publicly traded. Altair is worth about $7 billion, right? They make $600 million in revenue every year, right? Confluent, they're worth about $8 billion. They make about $800 million in revenue every year. So I'll just make a point and you'll jump in. So really, we're looking at market size. Like how, I mean, that's the biggest question. That's why VC team is a big question too. We'll get to some of this stuff later, but market size. Like if you dominate the market, if you sell to every customer that you could possibly sell to and capture everything, and it's only $50 million, like that's just, the company just can't be big enough. So VCs are very obsessed with market size, right? Yeah. So normally how these companies get valued is you're going to look at the revenue. You're going to look at the margin on that revenue, right? Is it like a 80% margin business or like a 5% margin business? And then there's going to be some industry multiple that's applied to it. And hey, if you're like a monopoly provider, maybe that multiple is like 20x. Here we had the 12x and the 11x. So there's different ways that these things get valued. But biggest point is like there needs to be enough money. You need to be able to make enough money. The market needs to be big enough. To even kind of get close to companies like this. Yeah. You got a question?
Yes. So, well, my question was that when you make those decisions, right, you use the valuation of the company.
Yeah.
Which is sometimes done by other people. So it could be not that. Do you do your own valuation of the company? It could be very subjective.
Yeah.
The actual value of the company. And also, is it a Series A, Series B company?
Yeah. Yeah.
And if you feel like the company is undervalued,
Yeah.
would you then accept, for example, to accept certain dilution levels that you would not otherwise accept?
Yeah.
Because you know that the company is undervalued.
Yeah. I mean, a very, very philosophical question, right? Like something's worth what someone else is willing to pay for it. Because at the end of the day, I got to sell my shares to somebody else, right? So it's like, what do I think it's worth? What's kind of really matters what they think it's worth in order for me to get the return that I need. And yeah, you can have like a view that's like, hey, I think that the market will change its perception of how this company's valued. And so maybe it's worth $10 a share now, and in the future it might be worth 20. But you need to be very careful when you're doing assumptions like that. Usually you need to think about, hey, I think this company's going to grow, right? It has $100 million in revenue now, but I think it's going to have $200 million in revenue in the future. And therefore like it's going to be worth more in the future. That tends to be how I think you need to think about it. I don't know if I directly answered your question, but hopefully that gives some sense. I think there was another question back there. Yeah.
So, I guess my question is, if you looked at a company like, let's say, OpenAI, right?
Yeah.
They were the Y Combinator,
Yeah.
right? Sam Altman gave them a bunch of money. But when they first started out, before Sam Altman got involved, their entire pitch was, hey, we're going to take a bunch of computers and hit this critical mass of AI, and it's going to take 2 years, and we're not going to make any money.
Yeah.
How would you pitch a company like that? Because it seems like most of machine learning and quantum stuff, how do you even put a cash flow or revenue prediction on something that's so cutting-edge?
Yeah. I'm going to not answer that question directly. I'm just going to talk about these next set of slides, which I think address that question, but then I might come back and answer how OpenAI was pitched. So, what are some of the things we look for, right? And this is a chart that shows kind of how a typical startup might fare across these categories, and maybe how deep tech startups fare. So one thing we think about is defensibility, right? So the thing that's going to erode your margin in a market is someone's going to come in and you're going to compete, and you guys are going to just compete yourselves down to marginal cost, right? And so that's going to destroy, any profit that you make. So we're really concerned about defensibility. And that can come in all sorts of flavors. In deep tech startups, it's usually like, it's just hard. Other people can't do it. And so that's something that we look at. We look at team experience, right? Do we think this team can actually execute on this? People show up and they pitch us ideas. And one of the biggest questions is it a good idea? Can this person do it? Right? So there's this concept of kind of like founder product fit, right? And I think that's very important in quantum companies. Like if someone shows up and they don't have a PhD in quantum computing, do I think they can build a quantum computer? That's a big question, right? Market size, we talked about that. In the later stage rounds, customer traction, right? So we can have opinions about everything, but end of the day, the arbiter of truth is there a paying customer? And so certainly as you get later on in the financing rounds, that's really important. Finally, capital requirements. Particularly these deep tech companies where you need to build a lot of product and you need to invest a lot before you're actually going to generate any revenue, they tend to have really high capital requirements. The mental model you can have there is pharmaceuticals. I have to spend tens, hundreds of millions of dollars in clinical trials before I can sell my drug. And so it's like, hey, you really got to invest a lot. All these things affect valuation. All these things affect, particular investors' willingness to fund. investors tend to specialize in different areas where they're willing to, accept different risks along these lines. And the other thing I want to talk about is team, right? So this is the other really important thing. People talk about the jockey and they talk about the horse. There's a lot of sports analogies in venture. So, the idea is like the horse, right? What's more important is, can the horse run fast, or can like the jockey ride the horse? Usually at the earlier stages, people care more about the jockey, right? Do I think that this person or this set of people, like, can they do the thing? And that kind of breaks down to these things, right? Do I think they have the experience and expertise in the technology or the product that they're trying to build, right? Do I think they understand the person that they're trying to sell to and the market dynamics? Can they like just get shit done? That's the number one thing that's important in startups, right? You just got to make stuff happen. Do they have the vision in order to recruit people before anything's built, right? Like that's the one, you can't do these things on your own. You have to be able to tell a story that can attract capital, that can attract employees, that can attract customers when it's just like an alpha, someone who's really going to like get excited about you and the thing that you're doing before it's really ready. And then the last two, like startups are hard, right? They're really hard. There's a lot of anecdotes about, hey, every company, comes close to death at least a couple times in its journey. Like constantly you're like running out of money. Like, I don't know if I want to make payroll in 2 months. And finally, integrity, is just table stakes. So usually in this environment, there's a lot of trust that's required. There's not a lot of financials. There's not a lot of reporting. And so end of the day, you kind of need to trust that the person that you're sitting across the table from, like they're going to be honest with you, right? About what's going on in the business. And it's really a partnership that you're engaging with. The relationship between VCs and founders typically isn't adversarial, right? Like we believe in them, we believe in the mission, like we're trying to do this thing together. And so if that ever gets compromised, it's impossible to work through it. And so it's really important that, everyone's really honest and straightforward with each other. I know I'm running out of time, so I do want to just talk a little bit, tying this back to maybe quantum computing. And I won't belabor this because you guys have spent a lot of time hearing about some of these things. But when I think about market structure, on the computing side, hey, there's the application layers at the top. There's some middleware in the middle that's kind of making these things easier to use. And then you have actually the hardware providers at the very bottom. One of the things that I think about is who gets paid the most, right? Where's a good place to invest when I look at a market structure like this? Like, the quantum hardware people are going to get paid, right? Because like they're doing the thing. And sure, it's possible maybe a couple of these could actually deliver business relevant quantum computing and there'd be some competition. But that's kind of like the hardest, it's the hardest thing to do, but it's the thing that I know is going to get paid. The other thing, if you looked at analog markets like, I don't know, maybe classical computing, usually the other people who get paid the most are the ones who touch the customer. So if you own the relationship with the customer and you're actually taking the tool and delivering business value, you tend to have really good margins. So I would think that the application layer would also capture more value. In this particular market, I think investing in application layers are very risky because I'm making two bets. I'm betting when is the hardware going to arrive and be relevant. And then not only that, I have to like believe that the application that I'm investing in is like the right one. So it's kind of like this 2 layers of risk. So I tend not to be that interested in investing in application companies at this time. And then finally, the other thing that I think is interesting is when you look at quantum hardware, there's a lot of these reports that talk about how it's going to transform industries. But you go and you talk to drug developers and you ask them, hey, is a quantum computer going to change, pharmaceutical development? And a lot of them would say, no. And so I think there is some open question around how much revenue are these things going to generate? Like once we have working quantum computers, there's only going to be a set of problems that are accessible. And how much business value are those things going to deliver? And so the timeline for when it's ready and how much money it's going to generate is somewhat questionable. But what I do think is it's a very complementary asset to cloud computing. And so I actually think that the best, maybe the most performant quantum computer, when it's ready and delivering business value, the cloud providers will be very interesting in paying a high premium for it, because you might want to co-locate all of your compute with the best performing classical or the best performing quantum computer. So there's an option for these companies to get paid way beyond the direct business value that they generate because of that complementary asset. Quantum sensing, I'm very bullish on. I think this is something that's delivering business value like today, right? And you guys have talked about some of these things that are that are available right now. But there's a lot of interest across mining, the DoD, GPS denied environments where you want to use gravimeters or magnetometers for doing localization, P&T sensors for knowing where you are and drifting if you lose GPS. Like all those things are applications that people really want, and the technology can actually deliver on it. So I'm very bullish on this. And then in terms of quantum networking, I'm more skeptical of this personally. And I think the biggest thing is when I look at who are the likely customers, it's like government. And so I think there is a lot of early interest in like, hey, how do we secure our communications, especially for very sensitive, particularly defense-oriented stuff. But I'm very skeptical that people beyond the government are going to be willing to pay in the near term. So anyways, we burned through that. I'm sorry, I think I took too much time. But I'm going to turn it over to the Atlantic Quantum team, people who actually know what they're talking about. And yeah, thank you. Maybe I'm going to have to run for the airport. So I'm not going to be able to join the panel. But maybe before you guys start then, are there like any questions that I can answer? And then we'll give these guys the balance of the time. Yeah.
I have a quick question. Thanks for all that. I was just going to ask, what happens to your failures, right? Like, suppose you get to year 5 or 6 and there's some company and they're hanging around like $5 million valuation. I mean, do you just write that off and say, all right, you tried, good luck with that, maybe you'll do better? Or do you say, all right, guys, turn out the lights, I want the money back?
Sometimes we shut it down and distribute cash. And like, again, this isn't like we come in and tell them they're turning the lights off. Like it's a collaborative discussion with the founder. Because also founders, if there's not going to be a big outcome, like shut it down, dude, go do the next company, right? Like you don't want to be stuck working on a 4 out of 10, like shut it down, start a new company. Maybe that's a 10 out of 10. Because it's not always the founder's fault. Like sometimes the market didn't hit or other things didn't happen. So there's always a collaborative discussion. Sometimes we shut it down and distribute cash. Sometimes we try and sell it, and get some money out. Sometimes we just write off the shares, take the tax, take the tax loss.
All right, thanks.
Yeah.
So, I don't know if you're aware of this, but there's already been some successes in options pricing using quantum computers. I was wondering if you're... sorry, I'll repeat for people if you guys didn't hear me.
Yeah.
So JP Morgan and ETH Zurich and researchers in those areas have already been successful in options pricing using quantum computers. And the extent is to eventually turn it into derivatives, and that'll lead to quantitative risk analysis and all of that nature. Do you personally see your venture capital using the same technologies you're investing in to evolve your venture capital fund at some point?
Probably not. Yeah. I don't see how it'd be relevant. We don't really do sophisticated pricing. There's a lot of this like, this is about $20 million pre. It's not that sophisticated. Sorry. Yeah.
Okay, thanks. I was wondering, when you're evaluating a company, how do you factor in things like red tape if there's a technology, like if it's medical or like getting it through the FDA? And then as a venture capitalist, do you actually leverage your relationships to help that happen? If you could speak to that at all.
Yeah, certainly. Yeah, on the regulatory side, I think, this is a risky business. So the number one thing is just to understand the risk that you're taking, right? I think you just want to be eyes wide open about what the risks are. The worst thing you do is you make an investment and then something happens that you kind of like weren't expecting or didn't anticipate like that could happen. Again, these things fail all the time. So like failure in and of itself like isn't really like notable. It's just being eyes wide open about what the risks are. And, like we can't really influence the FDA, but we can certainly help the company navigate that. Like, hey, these are the conversations you want to have. You understand what they're thinking. So you make sure you go to them with the right data package. Usually the things that we can help with that are better, like introductions to customers and bringing legitimacy. So, someone starting a company, they're an undergrad, are they going to really be able to get access to like the C-suite of some pharma company? Like probably not, right? But DCVC invested, and then we walk them in and say, hey, this is like really serious. You guys should look at it. And then it just gives them a shot to actually sell. Okay. Thanks, everybody.
Thank you. So, hey, everyone. We are going to introduce ourselves real quick. We'll go fairly quickly through our story. Do you want to go first in terms of who you are?
Sure. Hi, I'm Bharath. I'm the CEO of Atlantic Quantum. Originally from New Jersey, the great state of New Jersey. Yes, whoever Jersey guys we got here. Did my PhD at MIT. Moved up here about 2016, and finished the PhD now over 2 years ago, and spun out the company. So we're a spin out from Will Oliver's group, who I think spoke here just yesterday. Yeah. So in fact, I was his first student. He was actually at MIT Lincoln Lab for a good part of his career and made the move over right when I started my PhD. So myself, a few other of the students that started in the group at the same time, research scientists in the group. There's a whole bunch of us. I guess there's a few pictures. We started Atlantic Quantum as a spin out of the work that we were doing at MIT. And yeah, here we are today.
Yeah. And my name is Chloe Holzinger. I have known Atlantic Quantum for a couple of years now. I actually used to work for the seed round lead investor, Engine Ventures, and did the original diligence with the Engine team on Atlantic Quantum before moving over to the actual startup operator side relatively recently. So happy to speak to any of the VC backgrounds, if there's leftover questions there, or diving into Atlantic. But perhaps it makes more sense to talk about a little bit where we are today.
Yeah, so as you can see here, this is our lab. It's located not too far, about a 15-minute walk from where we are today, right actually right next to MIT. And I don't know if, probably most of you have seen the various forms of quantum computers and their physical realization. This is, as you can see, a dilution refrigerator. We are a superconducting qubit-based company, and so this is what our quantum computer looks like. That's Ebru. She's great. We use chips, right? So there's also like a Harvard startup. I don't know if Quera was involved in this, but they do neutral atoms. There's a whole bunch of flavors: atoms, ions, neutral atoms, superconducting qubits, spin qubits, etc. We work on a flavor that's very similar to what Google, IBM, and Rigetti that was mentioned earlier, superconducting circuits. These are circuits that, you're taking capacitors, inductors, just junctions, and making effectively artificial atoms out of them to form your qubits. So, you guys have probably heard from Will about what the work we're doing at MIT in terms of superconducting qubits. Specifically, what Atlantic Quantum has spun out of that, out of that group, is the fluxonium qubit. This is a new type of superconducting circuit. So there's many circuits you could build to form a qubit using superconducting circuits, and we're using fluxonium, which is something that's been in literature for a better part of a decade, actually. Almost as long as the transmon, which is the circuit that IBM and Google use, but has really not taken off in its actual use in quantum processors until very recently. And the reason for that was there was often this thought that the fluxonium circuit was way more complicated than what people could fabricate, and the benefits may not be actually there. But what we did, the work that we've done at MIT and a few others as well, has shown that no, not only is it not that hard if you know what you're doing to make these circuits, but they actually just work way better. And so, we had a paper that came out late last year showing that these fluxonium qubits are not only in theory better qubits, but actually have much better performance in terms of error rates compared to what is at least what is currently possible with transmons. It's about a factor of 10 is what we've improved. So we're a seed stage company, to kind of put things into terms that James was talking about. We've raised about 22 million total funding. So we had a $9 million seed. We've done a little bit more in VC since, plus some government funding. So a pretty large seed company for the numbers that he had up there. But that's really what it takes for deep tech, right? These are really hard problems, they're really expensive problems, but the market potential is effectively infinite, right? And so, the person or people that solve the hardware problem for quantum, right? This is what's going to start this whole revolution. As James mentioned, the applications are really important. We need them to be there. We need really smart people to work on these and continue to reduce the resource overhead required for doing all sorts of amazing calculations. But at the end of the day, if you don't have a computer to compute, then there's no point. And so that's what gets us really excited every day is really pushing the boundary of what is possible in hardware.
So why did the founding team decide to found a company rather than stay in academia?
Yeah, so there's really, because number one, academia was never really in question. So there's a few paths that James pointed out, right? Government, academia, corporate, startup. So, really the problems that we believe needed to be solved were too large of a scale to be solved in academia. And so that really got ruled out pretty fast. The question was, do we, go get jobs at Google or IBM or one of these Amazon, one of these amazing companies, or do we start something new? And really the technology that these big corporations are working on, they're doing phenomenal work. I mean, these guys are like some of my best friends work at these companies, right? And they're really doing great work. But fundamentally, the path that they've started, right, is based on a technology that we don't think will actually make it to the end, right? And so we wanted to, rather than saying, okay, we're going to make 1 qubit, 2 qubit, 5 qubit, 10 qubit, and make it work, right? This is how the technology has developed historically, is that you start from very small and then you slowly, you deal with problems as they come, right? And that's great when you're doing these very small scale systems and you're trying to just get an understanding of the foundations. But I think we're beyond that, right? I think now we want to build a 1 million qubit system, right? That's where we know we're going to need to be, somewhere in the hundreds of thousands to millions of qubits. And so we wanted to flip the script on that, right? Rather than saying, okay, let's go 10, let's go 100, let's go 1,000, start from the opposite end. What does it take to build 1 million qubits, right? The answer to that question depends very much on the hardware platform that you're working on, right? So the answer that the neutral atom guys will give you is different than the answer that we'll give you is different than the spin qubit guys, right? So what do? We do superconducting qubits. That's what we do best, right? So that's the problem we're gonna try and solve. And so if you take a look at the transmon qubit and how it's controlled and all of the infrastructure that's required for it and the cost per qubit and all these things, right? And even if you assume some very generous economies of scale to go with that, the math doesn't work, right? If you want to make a 1 million qubit processor. So we really wanted to say, okay, what are the engineering constraints that we are forcing on ourselves today, right? To build that 1 million qubits. And then, you're not going to go from 0 to 1 million in one day, right? You're going to have to go through that path, but don't fool yourself, right? Every time you increase the sophistication of your device, be bounded by the constraints that you set from the beginning. So this is our vision, right? We don't want to fool ourselves. We don't want to take shortcuts. We want to solve the problem that actually matters. And that's what we're exactly trying to do. We have until 3 or?
Only about 3, maybe 2:40.
Okay.
Okay. Maybe we can take a few questions. We can just dive into Q&A.
Yeah, why don't we just do Q&A?
Cool. Questions so far?
You said that problems that you have in quantum are too big to solve via the academic route. Can you expand more on that? Why you say that? And why is doing a startup preferable?
Yeah. So, okay, maybe I should clarify that statement slightly. Not all problems are solved, right? And some problems are better suited for academia. The problems that we wanted to solve, we felt were too big for academia, right? Which is, just when you start to scale the number of qubits, the costs you incur starts to grow, right? And an academic, MIT could probably pay for that, right? But most academic groups probably couldn't have that sort of scale, right? The other thing to think about is also just focus, right? In academia, what academia excels at is trying lots of things, right? A lot of things don't work and a lot of things do work. But you have 10 PhD students, they're most often, in most academic settings, working on 10 projects. And there's only so much you can do when you work with that. Even if you have a team of like 3 or 4 people, like it's just not enough. Whereas if you have a team of 30, 40, 50, 60, right, as it grows, people singularly focused on one problem, one vision, right? This is how you make real change at scale. And so, you can do this at a corporation, you can do this at a startup. We chose startup because we believed that what the corporations were working on weren't the solution. And so if we wanted to build what we thought would work, we had to do that ourselves. Yeah.
I guess coming from the perspective of a startup, how much of your focus was getting publishable results versus convincing the venture capitalists to keep funding it?
Yeah. So as a PhD student, I need papers, right? I want to graduate. That's like my number one focus as a PhD student, right? And so you often publish, not regardless of the result, right? But you just publish what you have, and sometimes it's great, and sometimes it's not. Sometimes it's good enough. But at the end of the day, you're a student, right? You want to graduate. At a company, our desire to publish has nothing to do with that, right? There's 2 things. One, we want to convince the world that the technology that we're building is a good technology, right? And so we publish to do that, and also to get feedback from people, right? That's always important. And so that's the driving motivation for us. Number 2 is, you also do have to. If everything you do is completely secret, people are not going to want to work for you, right? I won't call anyone out, but there are companies that do that, right? And me as a grad student, if I want to hire someone, I say, hey, come work for me, right? They'll be like, okay, but what have you done? Oh, I can't tell you. You have to start, right? What's your gate performance? Oh, I can't tell you, right? What type of qubit? Oh, I can't tell you, right? Then I'm okay. I'm just not going to work for you, right? And so part of it is keeping ourselves accountable, right? So that it's not just us making claims, we have proof behind that. And part of it is making sure we're able to recruit people so that they're excited about what we're doing. Now, you have to balance that with how open you are. You can't obviously give away all your secrets. And so there is a balance to be made. But definitely the reason we publish is very different than what I would say for a grad student, or at least for me personally when I was in my PhD. Yeah. Oh, yeah.
Me and Leon had done a presentation for the Quantum Economic Development Consortium.
Mm-hmm.
So I was just wondering, how does your company, Atlantic Quantum, work with the overall landscape of quantum economic development, and how does that look with the previous question of keeping some things close to chest, but also interacting with other people in the field?
Yeah, I mean, I think the way to think about this is we are by far not the first people to have to deal with that problem. Like all technologies have to go through that, all deep tech, computing, whatever, right? So this is a problem that always exists. We're not the first to deal with it. There's multiple ways of, I would say, when you talk about working in consortiums or partnerships and growing the group, there's a lot of ways for people to work together, even if you might deem them competitors, right? First of all, I think we as a community actually aren't super good at working together. I think everyone wants to be the winner, and that's great. And I think part of that comes from our academic upbringings, right? We all want to be the one. Well, okay, we're going to have a bunch of ones and no big thing, right? If that's the case. So I think part of it is putting our egos in check and actually, what do we care? Do we actually care about building a machine that works? I would love for that to be my machine, right? I'm working really hard to make that happen. But by no means am I going to tell you today that I'm going to win, right? May very well be someone else. And so I think the onus is on us, right, to want to work together. Now, there's easier ways of doing that, and there's harder ways of doing that. For example, you could look at Quora, a Harvard startup, and Atlantic Quantum. We're friends, right? We're great friends. They're working on something. I'm working on something. Well, I wouldn't even claim us as competitors, right? Because whatever technology they break through doesn't actually help me that much, hardware-wise, right? Because it's very different. Then you got, like Google and us, for example, right? We're working on very similar technologies. And so, yeah, there's a little bit more, we don't want them to exactly know what we're doing, right? And likewise. But that being said, there's a lot of great work that Google is doing on the algorithm side, right? On the resource estimation side and all these things. And these are things that we, especially as a startup, benefit from quite a lot. So those papers are very, very nice. So there's a lot of ways that we can work together, even though we might be sometimes working towards the same goal with different platforms, or even if we're working on the same hardware platform, other ways that we can work together.
Yes. Congratulations on your company, first of all. So assuming that your art was developed at MIT, I'm wondering, what is the structure of your intellectual property ownership? How does that affect your raising funds? And then I'd like you to then talk a little bit about the government funding that you have. What was the process and what's the source?
Yeah. So to answer your first question, anytime you spin out of a university, the work you've done is generally property of the university. Every university has a different way of dealing with that. It's usually called the TLO, the Technology Licensing Office. I'll speak to specifically MIT because that's the experience that I have, which, to be honest, was a rather nice experience. I think MIT in particular understands that if the university kind of gets in the way of preventing startups from really having access to the IP for a reasonable cost, right? Whether that cost is equity or licensing fees or royalties, whatnot, right? It can be all depends. The nature of a deal is very specific to each deal. The MIT understands that they don't want to be a roadblock, right? Can you break it down in percentages? Sorry? Can you break it down into percentages? Do they say you developed the technology so you get X percent, and we got the patent so we get Y percent? Yeah. I think at MIT, there's a pretty standard formula for the inventor. I think 30% goes to MIT, or a third goes to MIT, a third goes to like the lab, like RLE, or like the lab you're in, and then a third goes to the inventors. But that doesn't matter. That's like that's just if you're the inventor, what would happen? If I'm a company, I'm trying to spin out, I need to license that, right? And often you're kind of licensing from yourself. So what'll happen is you'll be on one side of the email saying, "Hey, MIT, I want to license this," and then they'll email the inventor, which is also you, be like, "Hey, this person wants to license it," and like, we're the same person, right? So that has definitely happened. But the terms of the deal of the license is very specific, right? So there's no real. I mean, generally, rule of thumb is you probably give up a few percent, right? So MIT gets some upside on this, but that can vary, right? Sometimes it's none, sometimes it's more. Sometimes you need more royalties. So that's really up to negotiation. In our case, for example, we did have a rather extended negotiation. It took about 2 years for us to get a final deal. But at no point in that situation was it MIT is not going to license us this, right? Like this is going to happen, and it's just a question of the details. And that with that confidence, investors also investors know this, right? And so even if you don't have that license like on day zero, they're okay with it because they know that MIT supports this. And so at the end of the day, you will have this license. The question is just at what cost?
I think from the investor perspective, the advice to a new seed stage company that's spinning out of academia is to reserve 5 to 6% equity in the company for the university technology licensing office. It could be less, it could be special. There's lots of different negotiations that you can do. But it should not be more than that in terms of the percentage of your company that you are giving to the university in exchange for exclusive license of your own patents. There are lots of universities that will try to get more, and that's thankfully not what Harvard and MIT do. But it is very university dependent.
Yeah. So given that you're in superconducting qubits and it's more of a long-term vision, so we get a whole hardware component, do you also have short-term business goals that you want to hit in terms of actual developing something? For example, we know that quantum sensing is already pretty good and that it works. Do you guys have other side quests, if you will, that volunteer, or is it too much deterrence from the vision that you want to build in super?
Yeah, we no distractions, right? We have a vision. It's a hard enough problem as it is, right? And something that my advisor Will always tells me, and I say it to everyone now. In fact, I just said this morning: is do things that make sense, right? And okay, the question is what makes sense depends on your environment, and if you structure the environment around you, the VCs that you take money from. In our particular case, if they understand that, yes, this is a 10 plus year venture, we're in it for the long haul and we support, we agree that your solution, if you can do it, is the right solution, right? And so do that, right? Do what makes sense. Now, if I took money from a VC that has a 6-year fund life cycle and they invested 4 years in and they need a return in 3, they're going to be pressuring me to do that, right? Now, what I would say is I didn't do what made sense in the beginning by taking their money, right? But if you're in that bucket and you need to make money, right, do what makes sense. For us, we make sure our incentives are aligned with our vision, and that means taking money from the right people.
So now I have the pleasure of introducing Dr. Sean Jones, our next speaker. While he sets up, I'll introduce him. Dr. Jones is the Deputy Lab Director for Science and Technology for the U.S. Department of Energy's Argonne National Laboratory, serving as Argonne's Senior Science Strategist, Advisor, and Chief Research Officer. From 2009 to 2023, Dr. Jones was employed at the National Science Foundation, serving as the Assistant Director for the Directorate of Mathematical and Physical Sciences. Prior to joining NSF, Dr. Jones was Senior Researcher at the University of Florida, Director of Engineering for Applied Plasmonics, Chair and Professor of Optical Engineering at Norfolk State University, Senior Scientist at LuxCore Networks, and a Technical Manager and Distinguished Member of the Technical Staff at Bell Laboratories of Lucent Technologies. He's authored numerous publications, has been awarded 9 U.S. patents. Dr. Jones received his BS in Material Science and Engineering from Clemson University and his PhD in Material Science and Engineering from the University of Florida. So today he's going to talk to us a little bit about his journey and a little bit about, and how to figure out cables and about the quantum landscape.
Again, this will be another presentation with no math. So this one's a little different. Bill actually asked if I could do this intriguing title, Navigating Quantum Spaces. And actually, I thought it was you navigating quantum spaces, helping you get to where you need to be. But Bill actually wanted me to tell you a little bit about my story. And so this talk's going to be in multiple parts. So again, multiple part talk. We are going to talk a little bit about the quantum spaces, who's considered in that. I am from the government, and so this is something that we put a lot of time, effort, and thought into. How are we spending resources to make sure that we're hitting a broad enough community, making sure that we're putting the right types of majors, degrees, et cetera, into the pipeline so the companies can thrive. And so I want to talk a little bit about the money, the funding that gets you kind of into those quantum spaces, and then what now after seeing, way too many PowerPoint slides on funding opportunities. So just to talk about my journey into a quantum space, first of all, my career path is not linear. So you will hear a lot of people today, you've heard earlier, people working 30 plus years at a university, 40 years at Bell Labs, et cetera. That is not my story. First, I was a non-traditional student. I actually graduated in engineering and worked for a few years. I wanted to get work experience. I was a co-op student as an undergraduate and worked in the chemical industry as a process development, product development engineer, and became a team lead or a lead of the largest production line for polyethylene terephthalate thin films in the nation at that time at Herc Celanese, but always wanted to go to graduate school. And so, as Nadia said, I went to the University of Florida. I studied material science there. And when I got out, I was also lucky to work at Bell Labs, at Lucent Technologies, and I worked on optical waveguides. Really nice to see the fiber talk a little earlier today from our colleague at Oak Ridge. And I traversed the pathways at Bell Labs from a member of technical staff, became a technical manager, and then DMTS. I actually had the fortunate opportunity to take a sabbatical at Bell and actually work at a Black startup company called LuxCore. Really appreciate the last conversation because I'm in the 67%. of those that didn't make it. And also appreciated the one hexagonal slide with integrity at the top. So this particular startup, I would say, failed because of that and because of your question. They had a fork in the road where we could have made a product or we could have went big and try to become rich. At that fork, we decided we're going to go big. We're going to sell this company for billions of dollars and be rich. And the telecom crash hit, and the company had no revenue. And so that was a strategic decision that our founder, who lacked a big eye, and that company failed. But luckily, I was on sabbatical, so I was able to go back to Bell Labs Lucent. But that telecom crash also affected Bell. So I was there for the last big hurrah, and I was there for the last hurrah for Bell and for Lucent in particular. Had an opportunity actually to work at two places that are not mentioned on here, kind of like Lord Voldemort for me. And one of them was another startup, again, another big integrity question, but it actually led me to the National Science Foundation. So I started at NSF as a program director, actually working on multiple programs. At that time, NSF did not value people with industry experience, even though I was from Bell Labs. And so I had a courageous manager who worked at NRL, who understood the value of people who kind of lived in multiple spaces, those that did R&D, those that did true development, and those who understood the customer space. And so she brought me on board, but gave me three jobs as opposed to one, like most people. But the one job that I had was working in the Centers program. And at the National Science Foundation, Centers are really one of the premier awards you can get at NSF. Other than that, it would be large facilities. These, telescopes, et cetera, light sources. Other than that, it's really Centers. And because I was in the Center program, that started, I would say, my true policy work at the National Science Foundation. How to organize people to do big science, how to organize groups to solve grand challenges, how to decide where resources will go, and how to stitch our centers with other resources so, again, that the community could grow. If we were just thinking about those fantastic individuals at that one university, from a taxpayer perspective, that really is not leveraging the taxpayer dollar to really do big science for the nation. So we spent a lot of time talking about how do we integrate instrumentation, education, along with research, with, again, these large center, large group programs. And that led me to doing a ton of different programs at NSF. I started the Sustainable Chemistry program within Materials and Chemistry. I worked on graduate ed because working with centers, our centers have large numbers of graduate students. I worked on a program called PREM, Partnership for Research, Education, and Materials, that's connected at that time to just our centers, our center program, that really looked at how to diversify science and bring more people of color actually into materials research. So doing those things, I worked with a ton of people across the foundation. I was one of the few folks that worked, I would say, with 70% of the foundation, from education to the international organization to actually the office of the director. I was connected a lot of different places because of the work, actually working on centers. And because of that, that led me actually to a detailed sabbatical opportunity to work at the White House. So I worked at the Office of Science and Technology Policy within the Science Division. And I did that for almost 2 years, primarily working on two items. The first one was administrative burden. I worked there in the Obama years, and he really was interested in the Paper Reduction Act, which is how can I reduce burden on every person who's trying to get federal dollars and make it easier for you to actually apply for a variety of things. But I worked on the science part. So any of you who are submitting proposals to DOE, NSF, NRL, whatever government funding agency, there's about 3 of us that wrote all those codes, or all the codes or the laws, to try to make it easier for you to actually apply for federal assistance. The other thing that I worked on, because of all the things that I was doing back in NSF, was the Committee on STEM, STEM education, co-STEM. And this is my first time working with the NSTC, the National Science Technology Council. They're actually a part of the OSTP White House, but they're kind of, they're attached or joined, right? But they're kind of the arm of OSTP and all the machinery around OSTP to say, we want all of government to have an approach on something. And so this is my first time kind of working on an all of government approach in STEM education. But being at the White House, believe it or not, for Office of Science and Technology Policy, the role of OSTP is to actually manage the science and technology enterprise for the nation. There's 50 people that work there. It's a really small organization, and so you're expected to be entrepreneurial and work on a lot of different things. And so I had because of my background, interest in nanoscience, and so I helped work with PCAST on nanoscience and try to keep that alive. Every few years, you have to kind of defend really large all-of-government approaches to certain things. And so I worked to make sure nanoscience was alive and money was still there. Broadened participation in STEM has always been something important to me. I grew up actually on an HBCU campus. My mother was a professor at one. And so I'm always interested in making sure that those who are not seen are involved and included. And this is a lot, so I'm dating myself, right? One, Obama, but two, the maker movement had just started, and it was not that inclusive. And so we had a whole team working on how to make making more accessible, but then to make sure that we had HBCUs and Hispanic serving institutions and tribal colleges, et cetera, all involved in making, and that was very rewarding. And I even worked on prison reform. And so how to use technology to reduce recidivism. What's not on here, which was probably the most fun I had at the job. For a while, I was the aquaculture czar for the nation. So I was the chief fish scientist for the country for a while. But that actually is a law that the Office of Science and Technology Policy will have some person that's making sure that we have viable seafood for the country. So when you work in the policy space, you might work on a wide variety of different things, but you can always find some interconnectivity. So because of the work at OSTP, when I came back from sabbatical, even though I'd already been doing policy work prior to that, again, thinking about how to mobilize people to attack grand challenges, I came back to the National Science Foundation in pure policy at that time. And that means being a manager at NSF. Because as a manager, what you're doing is you're looking at the portfolio of some sort and thinking again, how do I mobilize, again, people, infrastructure, and then science programs really to attack grand challenges and to reduce problems. Through this course of time, you always meet people who say, man, I'm so interested in doing policy. So I really want to do policy. I really want to get into this kind of work. Well, if you want to do policy, you really need to be motivated by a few things. And one of those is helping others do things. As a policymaker, you're not doing anything. What you're doing is you're reducing barriers so that others can be successful and prosperous in pursuing a quantum career or pursuing science and quantum. You also need to be about that, right? Reducing barriers and not putting up new barriers. So you're there really to help. If you are a policymaker and you're there because you want to control everybody, that's probably not going to be a successful career path. As a policymaker, you have to look beyond yourself and you have to think, how can I have as many voices and communities talk to me so that I can, again, solve someone's problem, empower somebody to do work that they want to do or do work that's good, and then, again, reduce barriers. So when I became, I would say, a bona fide policymaker or a manager, I started creating things, right? Creating programs to reduce barriers and to bring more people in. And so that's just a list of some of the programs that I created, and hopefully you recognize some of them. You're going to see a few of these again in a second when we talk money and how you can maybe leverage federal money to, again, do your own policy work, how to do your own quantum space, right? How to move and move successfully through the quantum space. So happy to talk about that slide, but certainly all these others as well. So again, I was at the National Science Foundation prior to coming to Argonne. I've been at the Department of Energy for about 6 months. So 15 years at the National Science Foundation. And I led the Mathematical and Physical Sciences Directorate for NSF. It's the largest directorate for now, at least, at the National Science Foundation. NSF's small, right? It's about $11 billion agency, and the Mathematical Physical Sciences Directorate is about $1.8 billion. It's the largest directorate by size, but it's also the largest directorate in terms of centers. They have the most center programs, and it's also the home for major facilities. Dune, CMBS-4, Ice Cube, all the radio telescopes, optical telescopes, and astronomy. So part of being the head of the largest directorate, you get to do fun things like, again, sit on lots of committees and work, again, with other groups like NSTC. So one of the charges I had for the last 4 years is to advance quantum for the country. So I was one of your chief policymakers, if you will, for quantum. And that, again, is through OSTP. So I was a co-chair along with Linda Horton at DOE and Carl Williams at NIST. And we helped, I think I was the second director from NSF to play this role, but we helped formulate much of the activity that underpins some of the work that you heard today. The NIST UMD Center, some of you are part of like QNext or some other centers. All of that work came out of this interagency working group thinking about how can we advance quantum for the nation and do it with whatever budget Congress is going to give you, because there are constraints when you do policy work. You wish you could just do whatever and you'd get money and everybody be happy, but you part of your job is to make sure resources are going to the right places, but also have those resources help you articulate why you need more resources. So one way that we do that is having the community organize around reports. It's real fun. All these committee meetings and whatnot. But this is just a sampling of some of the work of this interagency working group doing policy work on behalf of the quantum community. And the one on the bottom left is all about workforce development. Again, how do we work with universities and with companies to make sure that we can accelerate the work that we're doing in quantum? And this report kind of helps us with that. Now, as we were getting some of our briefings on the report, we were hoping it was going to kind of focus on industry, but actually they turned the report around a little bit and focused on K through 12 and outreach, because they're really worried that the public doesn't understand quantum. And when we start asking for significant amounts of money, one, there's fear because we learned that through AI with the public. But also, they just don't understand, what am I going to get or what am I going to receive? And people are scaring folks about quantum and finances. So really we're concerned about this outreach to the public. But they also raised the question that maybe the funding that we were doing, all the great work Linda, Carl, and myself were doing, is that we were focusing schools a little too much on PhDs. And so when you think about this pyramid of, who's working in quantum, we were putting a lot of effort and money into this, right? Increase quantum awareness and people who can actually do work in quantum at the top of the pyramid. But when you think about the needs of industry, actually, it's a lot of people down here actually that might not need as either higher degree or as much training. And so we asked from the report, and these reports are interesting, right? There's a link there. You can go and read a lot of these reports. This one has like over 100 recommendations, but I'm only going to show you a few. And basically it says, we need to have diverse backgrounds. So we love physicists, but we need more people than just physicists. We need engineers, we need chemists, we need people who understand like error correction from the computational side. And we need people to have more skills coming in. This is not like when I went to the chemistry industry, some of my unit ops courses were directly applicable when I went there. But they're saying that many of the people that they need to work in their industry are not exposed at all. So they need a little extra skill training. And then they ask us to consider how to do that through different types of programs, even to bring in people who might be, like those in the telecom industry that need to pivot back into quantum. So we turned to Carl, who from NIST, who helped start or establish QEDC, or the Quantum Economic Development Consortium. Part of their mission is to think about these kinds of gaps. And we asked them, can you verify or validate what we're hearing when this report comes out? And so Celia took that charge on. And actually, they came out with a report. And hopefully, if you haven't read this, because I'm sure you know, it's not as exciting about education, workforce development publications, but it's an interesting read, actually. And so I would highly recommend that you get this report if you are a student trying to understand what is the industry need, if you're a professor and you're thinking about curriculum development, and if you're an industry, is this still valid? This was done a few years ago, and this particular industry is moving rapidly right now. So some of this might not even be as valid as before. But they basically asked, there's 137 so companies in QADC, and 60 of them responded 100% through the survey that they sent out, just to find out a little bit more about what are the needs of the industry. And so first, there are a lot of different quantum industries. It's not just one thing. It's not just one qubit technology. It's also not just one type of industry that's related here. I mean, we also, there's people who are VCs who need to understand quantum, right? We just heard from two earlier. But of course, there's a ton of hardware that's needed for quantum. And so there's different types of industries that exist. They also told us that there's a significant number of different types of work roles, right? And so there are a lot of different types of quantum jobs. 3 years ago, again, through some of our funding, we would talk about a monolithic kind of perfect quantum person. The industry was saying, again, not exactly. They shouldn't all be experimental physicists, right? We do need some algorithm developers. We need people who understand photonics and optics, certainly data scientists and circuit designers, et cetera. It's a wide variety of people who can play. I know this is an eye chart, but this just reinforces the previous chart that besides different types of jobs, there's a wide variety of skills that are needed in the quantum industry as well. Over here, you have product development, software development. There's sales on here, people who can actually sell a quantum computer in terms of understanding its benefit to different markets beyond finance, et cetera. But we were really trying to get to this chart, which when polling the industry people, they said, okay, when we look at the pantheon of the types of people that we need, what are the types of degrees that the people have and also that you need? And what you're seeing here is green is predominantly PhD. So those who are doing error correction, you need to have a PhD to do those kinds of things from the company's perspective. When you looked at that pyramid, they're at the top of the pyramid. But when you think about technicians or people doing test measurement, a BS or even associate's degree might be enough, right? So the takeaway here is, because I know most of you probably are not undergraduates, but if you are a faculty member and you're designing your pathways for, let's say, an NSF center or a DOE center, focusing on your work, but your outreach, if you could focus here, that would be of significant benefit, whether it's connecting to a community college and having pathways for people to get exposure to quantum. So again, many types of jobs require only a BS or an MS degree. This one was interesting. They actually asked them all of the different types of skills that you need. Can you rank them in terms of this is a quantum skill and this is a non-quantum skill? And again, when you think about the diversity of jobs, right? Many of them, according to the companies, they would consider these folks to not actually have a quantum skill per se, where, only a few of these, and again, we're back to our error correction scientists, right? Really need to have skills that are quantum specific or quantum related. So again, important skills, many are not quantum. However, quantum exposure is enabling. So the takeaway here was from most of the companies, right? Lots of different types of jobs. They require different types of skills and knowledge, and a variety of degrees are necessary. Again, for success, just focusing on this one here, right? Getting hands-on experience. Again, we want people cross-trained across disciplines. And if you're not in a quantum specific discipline, we want you to have some hands-on experience prior to. And those who are in the quantum experience, that are in quantum disciplines or degrees, they really want you to be quantum ready when you come work at the company. So what does that mean for, let's say, students, right? For students who are working in this area and you are not already connected to a really strong group, there are a lot of opportunities for you to actually get connected in the quantum. And those of you who are undergraduates or graduates and you only stay in your one group, these are mechanisms that allow you to broaden your skill set as well. So the first one, I'm going to do a little hybrid of DOE and NSF here. So the first one would be for undergraduates, at least research experiences. And there's an actual research experience for undergraduates program. But I think we've been building out the community for long enough that you should reach out to centers that are actually doing work that's in quantum. So one of the first centers to think about would be MRSEC, so the Materials Research Science Engineering Centers. Oddly enough, the NSF quantum centers, policy decision we made was not to require REU of those. We wanted them to do a lot of other things, but some of them do have some summer experiences. But if you go to the MRSEC website, you will find at least 5 centers that have quantum activity that's ongoing. Another activity that we don't talk a lot about would be the MIPS, the Materials Innovation Platforms. And there's 4 of them, but 2 of them focus on quantum materials and in specific 2D materials. Instead of having REU programs, they have summer schools. And so they have 2 to 4 week long summer schools in a variety of programs, theory, data computation, and then actually how do you make samples? So thin film, but also bulk crystal design. And so they rotate that throughout the year, but they have the majority of them during the summer. This is open actually to undergraduates and graduate students and postdocs. Now switching to DOE, there are a ton of programs. Again, the point of these slides, if you're an undergraduate and you want to get some experience with quantum, you have a ton of resources. You have those from the National Science Foundation, but then you also have, through the Department of Energy, programs that allow you to go to a national laboratory and work. And so one of those, the largest program for us is SULI, the Science Undergraduate Laboratory Internship Program. And you can Google all these, but this link is active as well. It will take you straight to the links. Most of the laboratories will have their own fun activity opportunity on top of SULI. Argonne happens to have one called the Seasonal Internship Program. That's for the summer, but also can be extended throughout semesters. Again, most of the national laboratories, and there's 17 of them, have their own programs as well. So again, a ton of opportunity. You heard from Oak Ridge earlier today. They have programs. Argonne has programs in quantum. Berkeley has programs. Sandia. Most of the national laboratories has some presence of quantum on their campus. We actually consider internships and employment a little different. We actually employ students as well. So if you want to work at a national laboratory as a formal employee and start getting some tenure, we have programs that meet that as well. One of the good things about the employment program is open to U.S. and non-U.S. citizens as well. And then it's not just for undergraduates, it's for graduate students as well. And we have a program that helps you with your thesis. So those of you who need access to specialty equipment, specialty tools, or people who are working in theory and computation, and maybe your group is not connected to them, you can actually, as a graduate student, come work at one of the national laboratories and get help with finishing your thesis. So Argonne is where I'm from. We have websites that help you navigate all of these resources for Argonne, but also the Department of Energy as well. I did want to talk to postdocs just for a second. Postdocs, you actually can find our postdoc offerings on our regular employment page, but we also have fellowship programs as well. We have at Argonne at least 2 fellowship programs. One is called the Maria Gobert Meyer Fellowship, and then the Walter Massey Fellowship. This is important because these programs give you a little more autonomy. It's like being a faculty member or a staff scientist at the National Laboratory. Offers a competitive salary to that of a postdoc or even a first, starting PhD engineer. We will actually give you funds to start an independent research program. That funding lasts for a pretty significant period of time, and we build in a ton of support at the laboratory to make sure that you are successful. A little more detail there. So for faculty, just quickly, a few programs here just to highlight. Not sure if this applies to this group or not directly, but for those of you who are partnering with, we call emerging research institutions, those schools who haven't reached a certain threshold per year on funding, they can actually apply to get started in quantum. And there's a track 1 where they can work with you over the summers. There's a track 2 program for $5 million that allows them to actually partner with you with significant resources to actually have a substantive program. So this is, again, part of trying to do connections and connectivity. The LEAPS program, also in that same vein, is a program that allows you to collaborate, again, with somebody at one of the emerging research institutions. This is a starting initiating grant for those who are not already in the NPS portfolio at the National Science Foundation. You could do your own analysis using the NSF award search engine to kind of see what the community looks like. You'll see that it's pretty narrow, actually. The success rate is fairly low within NPS, and in physics and in condensed matter physics and in quantum in particular, this program helps you collaborate across the boundaries of people that you haven't worked with before. This, just really quick, those who already have NSF funding, this program in NPS allows you to do your own recruiting. If you find a student at a NSBP or Society Hispanic Conference or the APS conference, and they're interested in coming into your laboratory, you can add them on with as easy as a supplement. This is a automatic yes, and we fund that student even when your proposal is expired. You had a question in the back?
You say did not traditionally receive significant amounts of funding. What does that mean?
Yeah, so this program changes year to year on the eligibility requirement on the institution, not necessarily the person. And so it's seeking to look at emerging research institutions that are not typically in the portfolio. We were using a $50 million a year annualized amount, but that might have changed since I left. Not for, again, for the institution.
You already glossed over it, so I didn't want to interrupt you, but in your career life, you mentioned community service, and when I was fortunate enough to have a scholarship to a Jesuit school where I also did a lot of community service. What moment in your life did you think was significant enough for you to realize maybe I got to step out of research to give the opportunity to other people, give the same opportunity that was granted to me unto others? Ideally, I would like to do that for my nation of Puerto Rico. It's not really a country, but I would love to grant people like me the same opportunity that they were once given to me, right? What moment in your life do you think, was it as a scientist, or do you think was it younger in life, that the moment that struck you?
Thank you for that question. So I think it hits each person a little differently. For me, it was younger life. I grew up in a small town, Orangeburg, South Carolina. Even though it's small, I had 4 universities there. but the university that my mother taught at was South Carolina State College. And in South Carolina, the HBCUs at that time didn't have a lot of attention and didn't get the recognition that they needed. For example, Clemson is known for agriculture. They got their program from state. So I've always, as a young child, as a high schooler, saw the inequities that can happen because of policy issues. And so I've always been somewhat community oriented and community minded because of that. So one of the schools that's not on here was Norfolk State University. I worked at Norfolk State, and I was a chair trying to help my faculty members get funding at federal agencies. And just doing the rounds at NSF and DOE, DARPA, et cetera, really highlighted how bad it was. And I told myself, if I get an opportunity to go to NSF to help impact policy, to make a difference, make a change, I was going to do that. Took a little while to do that, but ultimately got there.
Thank you so much for everything you've done in that sense. And I wanted to mention myself, my career started not far ago at Northeastern. I was politics, philosophy, and economics because I wanted to create QEDCs in Puerto Rico. The legal battles that are ongoing there have frustrated me, so I switched back to physics.
Yeah.
But it's really awesome to see someone in your place do what you're doing.
Yeah, thank you. Nadia, did you tell me 3:30? Well, let me just mention there are a ton of opportunities through the government. Okay, there are a ton of opportunities. One of those I just flipped through was the visiting faculty program. Boy, I hope all of y'all know about the visiting faculty program. But since the last session was on startups, I did want to mention the LEAP program. This is a DOE-wide program about entrepreneurship and embedding an entrepreneur in the laboratory so that you have access to the people and the resources at these labs. I didn't do the commercial for Argonne. I skipped that. But Argonne is home of the APS, the Advanced Photon Source. It's the brightest X-ray source in the nation right now. We're bringing it online. And it's the home of the Aurora. Aurora is the exascale supercomputer. Oak Ridge has the number one, as of today, Frontier. We're going to surpass them any moment now and be the number one supercomputer. There's only two of those, right? Exascale in the United States. El Capitan, well, that will come online. That'll be the third, and all three will be owned by DOE. Through this program, you have access to these kinds of resources that you just wouldn't have staying at your home institution. And this program, again, not only gives you those access, but it puts you in a 2-year fellowship where you're learning from others how to actually have a successful startup. So we have 4 examples of quantum startups. And since quantum and microelectronics are somewhat of a focus at Argonne, each cohort has somebody in microelectronics or quantum that come aboard. So I definitely wanted to mention this. There was a lot of excitement about maybe starting your own venture. The laboratories are an excellent place to help you with that as you're starting to look for seed funding. But I kind of, to your point about how could you yourself maybe give back to science and back to the community, and there's several ways. The first way, really, I'm gonna just put it out there. You don't have to put science down to do policy, okay? Most of the agencies allow you to rotate in. Several people in this room I've talked to about rotating in. You go for 2 to 4 years, and the National Science Foundation and DOE will actually give you a day or two a week to still pursue your research. And if you manage that time well, you can still have a very productive research career. Your students will be fine, but you can come and help make policy changes and impact policy by doing that as well. If that's too much for you, if you haven't been serving on panels, please do that. Panels are the gateway almost to everything. As you are a panelist, you're one helping decide the outcome of the science that whatever that panel is producing, but program directors get to know you. The community gets to know you if they don't already. A lot of people will go to an NSF panel and start brand new collaborations. So that by itself is worth going. But what also happens is over time, the program managers and the managers there trust you and say, I want Bill to be on this executive panel committee for the White House that's going to talk about quantum. And the more you do that, the more you're engaged, the program directors are asking you to step in, but your colleagues that you're working with on these panels over time will do the same thing. It's a network ecosystem, and you have to literally opt in to get the benefits beyond that. So I'm hoping that if, as you're starting your career, if you're midway in your career, if you're towards the end of your career, that you're still volunteering to work on these panels because the community needs you. That's the only way science gets done. It is a team sport. I also want to mention fellowships beyond normal fellowships. So APS, MRS, and the AAAS have these fellowships. Those are typically policy fellowships. When I was at the White House, I told you there was 50 people there. Well, there was another 30 fellows. So these were people who came for a year to 2 years, depending on the fellowship, and worked on, again, grand challenges and helped decide significant decisions for the nation policy-wise, and working with some of the top leaders in science. Stephen Chu was there when I was at OSTP. Eric Schmidt was there. The top people in science are there. And as a fellow, you're working right alongside them. And the fellows are not just for students. So I know a lot of people think, well, that's really only for a PhD grad, and you only do that for the first or second year when you get out. A significant fraction of the AAAS fellows are actually people who are restarting their career. They were working in a particular area of science and said, maybe a policy restart will help me reimagine what the next phase is. And I actually had a few of those in my lab or my office when I went back to the National Science Foundation, but I actually worked with a few at the White House as well. So there are a lot of ways to get involved in policy work and work that's, I'd say, quasi-government as well. But with that, leave it open for a question or two. Yes, sir. And then in the back.
Hello, my name is James Patone. I'm a fifth-year chemistry PhD student. I liked your talk. Thank you for sharing all this. I also appreciated you being honest about your past, because I feel like a lot of Black scientists don't feel encouraged enough to do that. But my question for you is, maybe I missed it, but were there any K-12 outreach opportunities that Argonne offers that we could share amongst our own networks?
Okay, so the question was any K-12 So the answer is yes. Again, I'm going to go back to centers because our centers is where we mobilize a lot of our effort. Most of them are almost told that they have to have some K-12 activity and outreach. But there's a whole directorate at NSF called STEM Education, STEM EDU. Used to be called EHR, Education Human Resources, but they changed the name. But they have an undergraduate division, a graduate student division, and one that works on like under-resourced communities. And there's a lot of K-12 activity bedded in there, including citizen science and those who work with like museums and places like that. Significant amount of funding to like impact your community at a wide variety of levels. Yep, good question.
Applying to these fellowships and all of the opportunities that you presented here, does it make sense for us to read those reports and things that you brought up in the beginning and use some of that language in our applications? What's the best place to find those as they come out currently? Like, is it the OSTP LinkedIn? Are there places where these agencies are looking for input from up and coming budding scientists where we can make recommendations or be a part of Zoom calls or reviews on some of this information before it's published? Yeah. And do fellows also get time to do research or?
Good question.
Thank you.
Yeah, no, thank you. So let's see. You had a lot of questions.
Sorry.
There. Yeah, but for definitely, if you're applying for the fellowships, being up to date on these national reports is vitally important. That will make you extremely competitive for the fellows. So if they're OSTP White House related, you go to the OSTP page and they'll have a ton of reports there. If you want to go to Quantum, I would go to OSTP Quantum or the NCQO. There's a link there for the National Quantum, I forget what the National Coordinating Quantum. Yeah, NCQO. But yeah, if you do quantum that's an excellent point. We did try to make it easy. I forgot. I'm from the government. Quantum.gov was the catch-all website, and that is a page that was put up by the government so that you can find these reports that are quantum related specifically. Another great place is APS and MRS. I've been very pleased actually by their government policy side, and so they curate things that are important to the community from an APS perspective or an MRS perspective. Yeah, great question. Yep. Okay. Yep.
Thanks. Sean, so clearly we need to do a lot more work in workforce development to get into these, quantum jobs, quantum careers. But in the meantime, would you say that people with a military background already have a lot of those skills that you were talking about?
That's an interesting point, actually. So in that first report, the third bullet point talked about career pivots. And a lot of times what they're talking about are programs to retrain military, actually, or veterans. Is usually couched as veterans. But I think you're right. For some of those skills that were mentioned in the report, veterans, because of their work experience, will be qualified for test and measurement, potentially, things like that. So that's an excellent point to maybe make known for employers. But I will say there are two MRSECs that actually have veterans programs. And they use kind of like a REU, RET to actually bring veterans in and retool them. So they take their hard skills, if you will, right, working on oscilloscopes, things like that, and then modernize kind of their skill set to things like quantum, where they wouldn't have had exposure to that at all in the military, but it's easy for them to kind of make that bridge because of their work history. And so maybe we need more programs, like that can encourage them to kind of do a quick hop, if you will, into the quantum workforce. So that's a great point. Yeah. Yeah, excellent. Yeah. 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 And so actually the program I was talking about, the first one I've seen was the Harvard MRSEC that did that. Yeah.
Question for you, Idris Stovall. I'm one of the founding co-directors of the Applied Research Institute for the Mathematical and Computational Sciences. You're in a unique position, and I'm totally curious to see how you feel this as a department chair at Norfolk State University. And some of the challenges, that you happen across, you've actually seen the other side of that as well, from the National Science Foundation. So I'd love for you to expand a bit more on that, and just in general in terms of supporting HBCUs. And creating assets, in that ecosystem so that way those centers of excellence, can be daisy chained in some really cool and innovative ways because they're under-resourced. Yeah. So I'm totally curious how you feel those questions and just reflect.
Yeah, thank you for that question. That's a tough one, right? So Norfolk State, I'm going to call it a prototypical HBCU. Faculty teach 4 or 5 courses a semester. Those who don't, have not been exposed to the HBCU world, it is definitely a service-oriented kind of school. Even Howard, right? You might find higher teaching loads because their focus is just different on student outcomes, success, etc. And so you do find high teaching load and poor resources. But what you do find are faculty who care deeply about their students and the success of their students. And so that whole laundry list of programs that you saw were to provide on-ramps to level that playing field, but a lot more needs to be done. And one of the ways that institutions that have been, given talks today is to reach and use those programs to pull those faculty in to work with you and to use those programs to provide release time, because that's a currency that is sorely needed at most of the HBCUs, so that faculty can actually engage in research. They can be in the lab with their students, things like that. That's a starting point. And then we need to figure out how to leverage the resources that are available at national labs, at the schools through partnering so that they have access to those tools. And then we need to be on the road of like building in infrastructure at the schools. And so there actually is a small community that's working on the significantly large grants. They're not federal government entities to actually do that, but they need a plan that makes sense so that it can, actually be sustainable and can actually do the best good.